Hi, Leslie me back again, and I want to introduce Margaret Lund, who has many years of cooperative financial experience. And we call this an introduction or a refresher, but I really feel as though we can never hear enough about co-op finance. Understanding the finances of the cooperative is key to understanding whether you have a viable business. While many of us are involved in cooperatives because they're mission-driven organizations, if we don't understand our finances, we don't really know whether we have a financially sound business. And without a financially strong business, we really can't fulfill that mission. So, understanding these finances help us plan for the future, determine whether we can pay patronage dividends to our members, and whether we're charging enough for our services. So all of these, this is the responsibility of the cooperative board. So I will turn it over to Margaret. Margaret, prior to having a successful consulting business, was the executive director of the North Country Cooperative Development Fund for many years. And North Country is now known as Shared Capital Cooperative. I think a number of you have loans from Shared Capital. So thank you so much. I also would like to say, please mute your microphone during Margaret's presentation, or we'll have a lot of background noise. So Margaret, I turn it over to you.
Okay, great, thank you. So, so this is kind of a refresher course. We have other webinars on the CDF site. There's a much more complete webinar that's just about financial measures. There's a manual on financials for board members. So we have a lot of other more detailed resources that you can have. So I'm going to just kind of do an overview of some key terms and then talk about also particularly what board members should know. But I think after listening to Courtney and Deborah, it's really what all members should know. I mean, part of democracy is access to information. And it's not just access to information, it's understanding the information so that you can use it to ask good questions as a member. So I would even expand that middle dot to say all members. And then discussing how we might use these numbers to track and measure financial goals. And again, we are a business, so we probably should have some financial goals, but not all goals are financial, but sometimes you can use financial data to measure other goals that you might have about that might meet member needs or desires in some other way. So that's kind of what we're talking about. So how do we all speak a common language when we're looking at financial statements? So the first thing, we kind of at ICA Group and in my consulting, we use this kind of framework, this measure, monitor, manage framework. So what that means, measuring is about the past, what happened, what happened last month or last year in our business. Monitoring is kind of like, okay, what does that mean, right? Right now, it's like a present tense thing. And managing is like a future. So what do we want to happen? What do we want these numbers to look like next year or the year after? And so those are all responsibilities of all of ours. And so they have different kinds of numbers and things that go along with them. So the first thing, measure in any business, the income statement and the balance sheet are your classic two financial statements. When people say, give me your financials, that's what they mean, your income statement, your balance sheet. And to that, I would add a cash flow. You don't necessarily share cash flow statements with outsiders like your lender. But it's a really important thing for boards to understand where the cash is going. So that's a third statement that I would add, or a third resource I would add. So, and some of you may know this, if you know accounting, this is just total review for the next 10 or 15 minutes, but some of you might not. So let's talk about these statements for a home care co-op. So for a lot of people in a business, income statement's the most important thing because that tells you if you made any money. So revenue is your sales, how much money came in, your expenses is how much money goes out, and net income is what's left, right? Did we make money? Do we have any money? Those are the kinds of questions. So in a home care co-op, in any business, there's something called COGS, cost of goods sold. So those are the expenses that are related to actually doing the thing that you're selling. So in home care, that is us. We are it. We are the members. The members, caregiving, salaries, and the other expenses that go along with that is really is a cost of our goods sold, because that's what our good is. That's what our service is care. So so that number is going to be made up of all care, the costs of providing care. And then the next kind of chunk of expenses are operating expenses. So those are ones that are not involved directly. They're kind of indirect. They might be rent, your insurance, things you need to do to just run a business. Management usually goes in there, the cost of your overall management or other kinds of things like that. So that's how an income statement is structured. And so for a home care co-op, for example, an income, like in this sample, we would suggest you divide out, if you do both public and private pay, that you divide those out. So in most income statements, there's some divisions. There might be other divisions if you're trying to track your revenue from different sources. You always do public pay, but you're trying to get into private pay. So you'd start pulling that out so you can track, like, well, is that number growing? Is that number meeting what we thought it would be? So those kinds of things. And then if you get reimbursed for things like mileage, which sometimes happens, you might pull that out too. So again, all the financial statements they're always kind of a tension between like way too much detail and enough detail to be meaningful. And that's just something that, each co-op is going to be different. Smaller co-ops might have a simpler balance or income statement, and a more complicated business, it might be more complicated. But some basic divisions of where's your income coming from is usually useful. And again, the cost of goods sold, that's your payroll, but also paid time off. Might be some other fringe benefits. It might be some management expenses, something like that. And then you get, after the cost of goods, you get to your gross margin. So that's kind of like, how much money do you have left to pay the rest of your expenses? And here's some examples, right, of what is the rest. It's like your insurance and licensing and marketing and office and recruitment, rent. I mean, all the software, hardware, all that stuff is all going to be in these other kind of overhead expenses, that are what it costs to run any kind of business, almost no matter how much you make. And so those are kind of two different sides of analyzing things. So the things that are like directly related and things that are indirectly related. So your balance sheet is the other big important statement. And some people, they just look at income statements because they just like, what were our revenues? Like that's the most important thing. But balance sheets are important too, because balance sheets are kind of like, well, what do we have? Like, what do we own? What do we have? So sometimes people talk about income statements as sort of a flow. And then, the balance sheet is sort of like a picture in time. It's like something more solid and static. And there's lots of different ways to look at it. But basically, they're just kind of looking at your same business from a different angle with different kinds of information. And both kinds of information are important. And we'll see in the more in the monitoring section, like sometimes you need a number from one financial statement and a number from the other one. And when you put them together, that's when you can really figure out what's going on with your business. So all balance sheets for any business, they're assets on the one side. So assets are like valuable things you have, right? So that might be equipment or something like that. For a lot of us in home care, those are going to be accounts receivable. So like money people owe you, that's an asset. It's like IOU from whatever client you have. That's a big asset. Your cash is asset. How much money do you have in the bank? And then the other side is liabilities. So if you say assets are what you own, those are your things. The other side is like, well, how did you pay for those things, right? So liabilities is money you owe other people. So if other people helped you pay for those assets, if you got a loan to buy something, that would be a liability. For a lot of us, again, because payroll is such a huge part of the home care as a business, this is going to be like payroll that you at any point in time, your business probably owes at least a couple days, depending on when you cut this statement, a couple days of wages to a bunch of people. So those are going to be liabilities. And then equity is the amount that you own yourself. That's the member's money. That might be paid in money if it costs, whatever it costs to be a member of your co-op, $200 or $1,000 or $10 or whatever that is. It's also going to be your retained earnings. So the money that you've made over the years that the co-op has retained itself to help it make its own business work. So those things are going to balance in a balance sheet, they balance, right? So like you have all these assets, these valuable things, and they came from somewhere, and the other side tells you where they came from. So this is, again, I'm going to go through this really quickly, but here in this example, right, they've got money in a checking account, savings account. They've got accounts receivable from some people haven't paid them yet. They have some equipment. And then payroll liabilities is going to be a big liability. That's what, people have worked hours, but they haven't been paid yet because the payroll hasn't been run yet. You might have bank loans, and then you have members' money, common stock, and the net income from the current year, retained earnings, things like that. So again, there's the asset number, and then the liability number, and then the equity number, and those are going to be the same number. They're going to balance out. So that is a really quick review of basic financial statements. And again, there are lots of resources. There's general resources in business for just understanding those concepts a little bit better. And then we also have a financial manual that's just for home care co-op board members on the CDSF website. And there's also a webinar that goes through actually those same slides, but in a lot more detail. That's also on the CDF webinar. So I'm not going to spend more time, but I want to on those two things. But I do want to spend some time on this cash flow statement, because a lot of times in a lot of businesses, nobody even pays any attention to cash flow. And if you have a lot of money in the bank, you don't necessarily need to pay a lot of attention to cash flow. A lot of us don't have that much money in the bank, or we're kind of checking that number. So then cash flow does become really important. And one of the most important points, which is a little counterintuitive, is that income does not equal cash. Like a lot of times you'd say, look, I'm looking at my income statement. We made a bunch of money. Where is that money? We should have money, and we don't, right? And so the cash flow is one of the things that helps you figure out why you have the money you have, and where is this other money, right? So it really needs to be tracked separately. So I'm just going to give you an example here. So that was our sample co-op. They made $58,000. So that's their net income. So great. That's where we start. But, do they have that much money in the bank? Well, you have to look at some, and this is a little bit complicated concept in accounting. Depreciation is it's like an expense for equipment. It's sort of like the wear off of equipment. so you might pay $20,000 for some really big piece of equipment, and then instead of having that one expense happen in 1 year, you say, well, that equipment's going to be used for 5 years or 10 years. So you take a little bit of it every year or every month as an expense. And that's just a way to sort of even out that expense and help you make that income statement, those financial statements, more useful to use, more reflective of an everyday basis. So that's a little bit of a complicated thing.
Margaret?
Yeah.
I see, I'm not sure if you can see chat, but there's somebody who's requesting to be made interpreter. Yes, we need interpretation.
We don't have interpretation. I thought we did. So is there a CF person on here?
We do, and I can tell you that Liz Letner is working on it. There's a technical issue.
I am sorry. I thought somebody was doing this. Thank you, Luis.
Sorry, we're having a technical issue with the translations for this session. So if you all could just be patient a little bit longer.
Okay.
That, but let's keep going.
Okay. So sorry. No, so I'll keep going. Yeah. Sorry about that. Okay. So the other thing in the cash flow, so you'd say, well, okay, so we made some money, right? But a big thing, again, for us in home care, we don't have a lot of equipment, so depreciation actually isn't that big of an issue, but accounts receivable and accounts payable are. So accounts receivable, it's money, we worked and we built somebody and they haven't paid us yet. So it goes into the income because we made, we did that work. But if we haven't actually got the check yet, then we're not going to have that money in the bank yet. So that's important. Also payables. if we have to, payroll again is the biggest payable in home care usually. But if we were, heaven forbid, like a little behind and paying people or something, or we had another vendor of some kind that we were supposed to pay that we haven't paid, we'd have a lot of money we'd have that money in our bank account, but it wouldn't really be money that's available for other stuff. Because we need to pay somebody else that. So prepaid expenses, a really big one you see often in home care is insurance. If your insurance makes you pay for a whole year at once, or even 6 months at once, that can be a huge cash flow drain because you have to write this really big check, even though realistically that expense pays for a whole year. So you expense it on your income statement, maybe 1/12 of it will show as your insurance, expense for that particular month. But the actual reality is you have to write this big check once a year. So that's prepaid. You might prepay that expense. So there might be a lot of stuff that happens that in this example, right? You thought you made $58,000, but really you just have this $26,000 in the bank. But maybe you have some new members that join, so that adds cash. And then again, a big one is loans or other financing. And that happens again in both directions. The month you get a loan, all of a sudden you have a bunch of money in your bank account. And that's not revenue, but that's cash, right? So you have a bunch of cash. And in the same way, you have to make loan payments. So that's something, again, it's not a revenue thing. It's not an expense. The interest portion is an expense, but you have to make these loan payments and you're going to need the cash to do that. So that's cash flow from financing. So again, in this particular example, the co-op made $58,000, but then they added a little bit, they took a little back, they added some, they took some back, they added some, they took some back. And then at the end of the day, you'd have a cash balance in this particular case that was, $9,000 more than the net income for the year. And so as a board member or somebody else, you'd say, well, okay, why do we have so much cash? And you kind of take a look at this and you'd say, oh, well, because we got this big loan. That's the big reason, right? We got a big loan. And so there are these other things that have happened, but that's one big reason. So, and I want to just talk a little bit, this is a little bit of a if you're not an accountant, difficult concept is this thing of accrual, but it's important from a analytical point of view. So there's two kinds of accounting, cash and accrual. And both of them are fine and legitimate and are used in different situations. So cash is the easiest to understand. So cash is you book it, you put it into your financial statement, somebody enters it into QuickBooks when you actually get the money. So revenue would be booked when you get the check. And the same with the expense. It would be booked when the payment is made. And for most small businesses, that's just a fine system. There's nothing wrong with that system. Accrual is a little more complicated for a little more complex business. And for our kind of business, it's usually best. So accrual, the revenue would be booked when it's worked. So you would have that situation so that if you did some work in July, and even if you work maybe for a public pay client that takes 2 months to pay you, you book it in when you actually earn that revenue. And the same with an expense. And that's again where instead of having one big insurance expense once a year, you would accrue it over the months. You would take 1/12 of it or something like that. So which should you use? And in our case, we're kind of recommending, and more than kind of, we're saying, that you use the accrual would be the more accurate one from an analytical point of view. And you can kind of, if you think about this, like let's say you did this really big amount of services in July, but you didn't get paid to September, then it would look like, oh, September, we made this huge amount of money. We made $100,000 in September, but that's not true because what you actually did was worked the same amount in July and August and September, but you just got all these checks in September.
Hey,
So-
Margaret,
oh, yeah,
a request from the chat for you to speak a little bit slower.
Okay, thank you. Are you monitoring my chat for me? Somebody's supposed to be monitoring my chat for me.
I am
yes.
supposed to be monitoring.
Okay.
Yeah.
Okay, I'll try. All right. So again, from a when we get into these next parts about monitoring and planning, this becomes important because what you want to be able to do is know, was this July like last July? Or was this July really different? And if, and you care if you got paid, when you got paid the check, did you get paid the check on the 31st of July or the 1st of August. I mean, you care if you got paid, but whether that happened in July or August isn't as important as knowing what you worked. What did you earn, right? So that would be the way that we would know that billing was really down this July compared to last July. That's something we need to talk about. And so that's where accrual really helps you, because it said, what did you kind of earn? As opposed to when the cash came in. And when the cash came in, I'm not saying that's not important, but that's like a different discussion. That's your cash flow discussion about like, wow, we're earning all this money, but we're not getting paid in a timely way. What are we going to do about that? That's a different important discussion. Okay, so that's really quickly this idea of measuring. What are we even measuring? What are these numbers that we're looking at? What numbers should we be looking at? What are these numbers? What do they mean? What do they tell us? But what we really want to know is, again, what do they mean? Monitoring. What should we do with this number? Okay, so I have this income statement, I have this balance sheet, and I have this cash flow, and there's a lot of numbers on it. And I don't, what numbers should I pay attention to? What's important? What do I even do with this, right? That's a pretty common question. What do I even do with this? So, so that's what we're going to talk about next. So what is monitoring? So monitoring is kind of saying to yourself and to each other, well, why is this number, what does this number mean, right? What does it mean and why is it the way it is? So one important way, and again, I'm going to just go back. So really, some really key ways: you might monitor your figures over time. You might monitor your figures according to a budget. You might monitor your own numbers, your co-op numbers, according to something called a benchmark. So it's kind of a standard for the industry. What do lots of other people in the industry do? So over time, that's, that makes sense. That's important. So our sample co-op, they're like, okay, this year we made $1 million. And last year we made a little less than that. So that's great, right? So we made more money this year than last year. So that's good. And then you might look at your cost of goods and you say, well, they were a little bit higher, but that's okay because we did, we provided more service. So that would make sense. You might look at net income compared to last year and say, that's great. Look, we made more money than we made last year. We had more revenue than we had last year. And like a lot of times that's a really good comparison. Now, we all know from like 2020, a year like no other, like that it's not always the right thing, because maybe 2020 was a completely and utterly different year than any year we're ever going to have in business. So maybe that, like going in the future, maybe that's not the best comparison, or that comparisons over time sometimes are useful, often are useful, but there may be circumstances where they're not as useful because some weird thing either happened this year or last year or something that's going to make one of those years not standard. So that's why we look at a bunch of different ways to look at numbers, because you'd say, well, that's one good piece of information. Okay. Another one might be comparing to budget. So we should all have budgets. I'm going to talk about budgets later. So the budget for the organization is before the year even starts, you kind of get together and you talk a lot about what do we think is going to happen this year? What do we want? What do we aspire? What's the year that we would really like to have? And what do all those numbers look like? Do we have we have a goal that we're going to increase our revenue? We have a goal maybe that we're going to, try to take care of some operating expense that's been hard to mileage or something that's been hard to control. We're going to try to control that. So you might have some goals, and those are implicit in your budget. So if we look at our sample here, like we were feeling pretty good because we did better than last year. So we'd be like, yeah, that was a great year. But then you look comparison to budget and you're like, well, it was better than last year, but it wasn't as good as we wanted it to be or that we thought it was going to be. So you'll see, we did $1 million. That was great, but we thought we could do 1.2 and we didn't. So a budget isn't a weapon. It isn't like something to get mad about. It's something to say, why? Why did we not meet those goals? That's what you want to be talking about. What happened that we didn't meet those goals? Might be that we expected a marketing campaign would have better results than it did. And so then you would say, well, okay, why didn't it? I wonder why it didn't. We didn't market to the right people, or we were wrong that those aren't the people that are going to hire us. It's maybe somebody else. So it's really just about having a conversation. So that's what we thought was going to happen and what did happen and what's the difference. And so in this case, the first comparison to time looked pretty good. We made more money than this one compared to budget. We didn't make as much money as we wanted to, or we thought we'd be able to. So it's just part of a conversation. And then the third one, this benchmark, we're going to have sessions, whole sessions about benchmarks for the industry, but those are sometimes useful too. And again, it's just another point of information. So you might say to yourself, well, what do everybody else in the industry do? And here's a really important thing for home care co-ops, because everybody else is mostly they're privately owned. They might be franchises or big chains or little or mom and pops, whoever they are. They're not worker co-ops. They're not owned by caregivers, except for us, right? So for somebody else that owns an agency, the caregiver wages, that's a cost. That's COGS. They want to keep that cost down. They want to keep it down as much as possible because that's how they run a profitable business. But for us, cost of goods is us. So maybe we don't care about that industry standard. Maybe our industry standard is going to be different in worker co-ops. And our industry standard is that, because cost of goods is wages. So we might be just fine in this example. We say, oh, well, our cost of goods are quite a bit higher than an industry benchmark, but you know what? We're okay with that because that means we're paying people more, we're giving better benefits, we're doing something that's going right to workers. So that might be okay. But then again, we're going to look at our operating expenses because it doesn't mean we're going to have, we have to find that money someplace. We're going to pay workers more, so we have to find some savings. So that's probably going to come from operating expenses. It's going to either come from profit or operating expenses. So again, we look and we say, okay, in our sample co-op, our operating expenses are lower. They're quite a bit lower than the benchmark. So then our question is why? And maybe they have like a super fancy office and we're okay with not having a super fancy office. So we're saying, well, that's okay. We're okay with our operating expenses. Or it might be that we're not really buying the kind of insurance we really should buy. We're not spending on something that's pretty important. And so that might be a question and say, well, we're not really comfortable with that number being lower than other people, or we want to look at that a little bit more. So all of these things are just things that might generate more conversations. And again, in our example, our company is still profitable. It's a little bit less profitable than most businesses in the industry. And we might say to ourselves that that's okay, that it's okay for us because we see that we actually put a bunch of extra money into the cost of goods, which is wages, which is our members. So we're okay with our comparison to this benchmark in this example. So those are, again, the kinds of things that you would talk about. So important, I want to talk just a little bit about, and I know I see there's a lot of questions in chat, so I'm going to follow up so we can get to those questions. But just a tool that's really helpful, because we've been talking about there's lots of numbers, lots of questions, lots of places to dig. It can just be like, how do you even know where to start, right? Like, what should I do? How do I know as a board member, as a member, to even know which of these numbers to start asking questions about or wanting to learn more about? I just don't know. It's a lot of stuff. So a really helpful thing is to have a dashboard. So dashboard is really just a set of information and data that we've decided are important. We decide on the most important things we're going to measure this year. We decide what is our benchmark or our goal that we're trying to meet. And then we share that. So it's a very succinct way of looking at the most important numbers. So that's often really helpful for a board to use this kind of a statement. So that doesn't mean it takes the place of reviewing the financial statements, but it really helps concentrate the conversations on the things that are most important. Because as Courtney and Deborah shared, you have an agenda, you have a board meeting, you have only so much time. So let's talk about what's important. So how do we know what's important? What should go on the dashboard? Whatever is important to you, I mean, honestly. So it might be some of these comparisons to your budget. That's pretty standard to have a comparison to budget or comparison to last year. If you have a particular goal, you're trying to meet industry benchmark in some way, that might be there. It might be trends. We're trying to improve a number. That's really important to us. So we're gonna track the improvement of that number over time. So the most important thing, it just counts progress against a goal. So that should be a specific goal, and it should be a goal that's shared. So it's a goal that you've talked about and you've all decided, okay, this is really important. And you can pick a different number next year. That's pretty common. Some things are there all the time, like comparisons to budgets, pretty standard. Almost all boards look at comparison to last year, the income statement to last year and the income statement to budget on a regular basis. But you might have a particular goal this year about, might be about recruitment or retention, or it might be about growing a certain element of your market. You're trying to get more work from this X, Y, or Z client. So whatever is important to you. And so you might start with the goal. Somebody's not on mute. Could somebody mute their background noise?
You should be able to mute them.
I should be able to
Yes,
mute them.
Right.
Right. Okay, I'll see if that works. Okay, so if you're going to set up a dashboard, and this is something consultants like CDF or ICA can help you with, you start with a goal and you think about measures. So you might start just thinking, what are some things you struggle with in your co-op? What are some goals you'd really like to meet? What would you like to be able to communicate about regularly to your members? And then you think about ways to measure it. What would make you think this is a true, that we hit this goal? So you might have a goal like, we want to be a really good employer, right? That's a really good goal. But what does that mean? Like it might be wages, it might be the percentage of benefits, that might be something you track. So it's okay to start with simple measures and expand on that, right? Just start someplace and your conversations will kind of help you figure out what are some other good ways, other things you might want to do. So like recruitment and retention, this is just an example because this is super important to lots of people. Might be hires, net monthly change, applications, interviews. So again, this is stuff that's not on your financial statement that you might be extra data you need to collect, but how many applications do you get from difference? And how many of those turn into interviews? And then how many of the interviews turn into hires? And then do those people stay? So that might be a kind of thing that you're tracking. If you're saying, okay, we're going to start marketing, we're going to start recruiting in a different way. I wonder if it's working. So you're going to look at some numbers and that are going to try to help you. So maybe you get a bunch of applications from one marketing source, but like none of those people are really people you want to hire. So that's the kind of thing you want to know. So those would be some numbers. You might be average caregiver compensation per hour. That would be a super important number. We want to be a good employer. And one of the ways we do that in an important way, not the only way, but is through compensation. It might be voluntary departures. It might be who makes it 90 days. I mean, so there are lots of things. Again, these are just like if you decided recruitment and retention is your most important issue right now or a really important issue. These were some of the things you might think about. And again, it just depends on the metric. Some of the things you track weekly, some you track monthly, some you track annually. So it kind of depends on the thing and then the number and like, is this a thing we would track every day? Not really, because it doesn't change. We'd want to track it every month, maybe. Weekly, you do client hours because those are really important, but your revenue, you might do monthly and then some other things you would do annually. So these are just part of the conversation. And then once you have your numbers, there's different ways you can look at things. So trend analysis, I like trend analysis because it's not just a static number. It's not just, did we do better than last year? But it's like, if you're trying to make some number better, you look at it maybe month to month. So in this example, trend analysis, so the dotted line is kind of where we want to be, and the red line is where we are. And we all know, I mean, things change month to month. We're in the kind of business, they change daily. You get a new client, somebody on and off, and who's on, it's just things change all the time. And so trend kind of helps you smooth out some of those lines. So in this case, when we look at the lower right-hand corner, this co-op says turnover. Like we want our turnover to be lower. So they're looking at that on a monthly basis. And then they're also there just looking at it. Presumably they're doing some things to help make turnover not happen as much. Maybe that's surveys, maybe, there's lots of things. And then, so happily they're below, we were above it before, but now we're below it. Starting in about March, we saw this turnaround. We saw a little uptick in June, but then really we've been doing really well. So that, so that's great. Client satisfaction, it's one of those other things. It's not where we want it to be. We've been doing some things. We're trying to track and see if what we're doing is having the result we want. So, so I like trend analysis, and again, it just depends on which number you're trying to track, and then what timeline of trend is going to make. And these are all monthly. These are things that are being measured monthly, but there are trends you could do weekly and annually. You can combine multiple sources of information on graphs, so sometimes that helps. Again, this is a recruitment metric, so it's like people call back and do they show up and do we hire them? So that would help you sort of see, like maybe we have a ton of interviews, but we don't have a ton of hires. So something's going wrong between, one phase of this and the other phase. And this is just a sample of a benchmark of a dashboard from a home care co-op. So this is a co-op where recruitment and retention is really important. So they're looking at this every single month. How many applications we get and how many hires did we get and how many people did we lose and what's the net change? So they're, because this is important to this co-op, they're monitoring it every single month and they're saying what's going on, right? And then you might say your average billable rate, your billable hours you want to be tracking. And this co-op has, you see at the bottom in the pie chart, they have another goal, satisfaction goal. So we care, most of us, I think all of us, if caregivers are happy. So that's important. So we're going to be doing some surveys to say, are those caregivers, are we happy, right? And is that changing? So again, this is just a sample of a benchmark or a dashboard that some people used. So you'd be asking yourself, so what are kind of, sort of the 3 to 6 key metrics, and they can be across different areas. And then you'd say with whom and how do you want to share them? Maybe this is a board metric or it's something you're sharing with members, particularly in things like recruitment. That's really something to share with members because members are your absolute best, 100% best source of new, really good caregivers. So that might be a metric you want to share with all your members. You say, members, we have this goal as a whole co-op of hiring X number of people, and we want those people to stay for at least 6 months or a year or more, or whatever it is. Help us out, like help us recruit, help us, tell us what we could do to keep our retention better. So those kinds of metrics are really things that members can work on. And again, it's really okay. Start with simple measures. If it's overwhelming, just start with some simple things and then grow that, make that work over time. So the last thing I'm going to talk about, I know we have a ton of questions, so I'm going to get to questions, but and this is from a board point of view, really, but your third responsibility, you're going to measure things, you're going to have accurate measures, timely, accurate measures of things, and you're going to monitor those, so you're going to decide which are the most important, and you're going to be looking at those numbers all the time and saying, okay, we're seeing, are those numbers going up or down or whatever. But then the third thing, is this managed? So you're like, I know what's happening, but it's not, I wish something else were happening. I wish we were better at something. There's something that we would like. We have an aspiration that's a little bit bigger aspiration than just, a month to month aspiration. Like there's something things we want to do. We want to grow. We want to be bigger. We want to add healthcare benefits. There are things we want to do. So those are longer term things. It's kind of a managed thing. So what are the tools you use for these longer term, bigger picture kinds of questions from a board? So a really important one is budgeting. So every single year we should have a budget. That is the way that you hold yourself accountable. And it just, again, a budget it's not a weapon. It's not like you didn't meet budget, you failed. It's a conversation, it's a tool. It's a way to say, what do we really think we can do? And what do we want to do? And it's a tension between kind of what are we confident about, but also what do we aspire? So there should be some aspirational aspect to a budget, but not completely out of this world, because then if you fail to meet it all the time, it's not really helping you out. So it's sort of aspiration within reason. And what does that mean? And only you can say what that means. That is a conversation that a board has, and board with your administrator, with your management staff. And because it's so important, you should put it on your calendar. It should be on your calendar every year. You start drafting it. You start it like this board calendar sample is for a board that they have a calendar year is their fiscal year. So they're starting in September. This is a conversation you have during the entire last quarter of the year. You start gathering these numbers, you start drafting. Usually the administrator will do a draft, but that will just be a draft. You'll say, well, where do we get this number? Where does this goal of ours work into this budget? What do we think is going to happen? So that's something that you'd have some back and forth before you would pass a final budget. And some co-ops, they share the budget with all the members at the end. And in some, it's just a board responsibility to do that. And again, so that's something that just should be on there every year. And I would talk just a little bit about strategic planning, because strategic planning is something that is really hard to find time to do. Everybody is really, really, really busy all the time. And it's hard to take the time to say, okay, we're just gonna take a day for a retreat or a day and a half, and all we're going to do is talk. we're not going to do any real work. But it's really important because, you know, in a co-op, particularly in a worker co-op, where you have a lot of members and they elect the board members. I mean, we talked a lot in the last session, in the governance session, if you were there, about communication. And sometimes what breaks down between board and management is poor communication, or people not understanding, not being on the same page, and all of that is really true. And strategic planning is one of the ways that you have a really good conversation about what you want. What do you want to be, right? Where do you want to go? And this could be something that could be multi-year, like something that's really common. One of the co-ops I work with, right? We want to be able to pay healthcare benefits, but we can't. Every year we try to fit it in the budget, and every year we can't, right? And so that might be more of a strategic question, that it might take a couple years to think about what are the things we'd have to change, what would need to happen in this organization for us to be able to meet that goal of paying benefits. And that might mean we have to change our mix of revenue. We need to find some customers that are going to pay us more money. Or something, right? That's like something you do in 1 year or 1 month. Like, so that's something going to take over the year. Or we have a really expensive office space or something. We have 2 more years left on that lease, but we need to get that number down. We need to find some way, you know, over some course of time to find this extra money, because our goal is to use that extra money for benefits in this case. So so there's lots of things. So strategic planning is just something, again, that every board should put. Maybe you do it every couple years, maybe you do it every year. So again, this slide has got things you do, you know, on a board calendar. Some things you do monthly, some things you do quarterly, some things you do annually, and some things you do every couple years. So these are all feeding into like helping you become the organization that you want to become, right? So I know we have a ton of questions, and somebody is going to help feed me some, right? And I think I'm going to stop sharing my.
Yeah, it's Leslie. And I'm sorry, we are having a problem with the Spanish. We've got a ton of Spanish questions too. And I have a problem with the translation of those. The first question that we did have was someone asked about what's an acceptable margin on your budget? You adopt a budget, and then, you know, when you know if you met it enough.
That is a really good question. That's like a materiality question. And it really depends. It kind of depends on which item it is, and it kind of depends on how tight you budget. So in most cases, like for example, revenue, if you're a couple percentage, you know, revenue is like 1% or 2%, you'd be like, well, we pretty much hit it, because it's really hard to hit it exactly. But if it's an expense number that, if it's, whatever, something, let's say your occupancy expenses are supposed to be 3%, and instead they're 5%, you're like, well, that expense number is important because we only have a 2% profit margin. So that not meeting that expense budget, that took our profit, right? So that's a really good question, because like a lot of times people focus on expenses because that's, that's completely logical. That those, like if you spend that money on something, then it's not profit, right? But it's always a balance between revenues and expenses, because you can't cut your way to growth. Like, so cutting expenses is a really good short-term strategy, and really good. Often that's what you have to do, because you're like, oh my God, we can't afford to spend this much. But growing revenue costs money. So this is also part of the budgeting question. So if you're going to say, I want to grow our revenue, I want to find these new customers, you might have to increase your expenses, your marketing budget. So you might increase your expenses. So it's a good question overall, but I'd say that when is it? I mean, ultimately you have some ultimate numbers you want to reach. One might be profitability. You know what? Whatever happens at the end of the day, we can't be losing a ton of money because we don't have a ton of money to lose. So profitability, that would be a good place where you'd say to yourself, maybe on your dashboard, like, okay, we have this budget, but a really important thing on our dashboard is we have to have a net profitable year, or we have to, there's some sort of the buck stops here on one of these numbers. So anyway, but it's a good question, but I'd say a lot of it is materiality, like how much can you afford to not hit that number? Honestly, that's a big question. And maybe if it's really important, maybe you want to budget you put a little extra in the budget for something that you don't have a lot of information about. You're like, I don't know what's going to happen. So I'm going to give myself a little padding here. Whereas this other number, we really know this number. We should be able to meet this budget. We should be able to hit this number all the time. So I'm not going to give myself some padding on that. I'm going to make that what I really think is going to happen. So, okay. Yeah.
So our next question is the goal line
Yeah.
in the trend analysis always flat?
No, that is a great question. We should have a different example. We should have a different, like in this particular case, and again, yes and no. Like in this particular case, a co-op is trying to say like, okay, this number is not where we want it to be. Where do we want it to be? We want it to be at least this. And so that's why in that trend analysis, it's flat, because we're saying like, it's at least that. But what you'll see, like I don't have the sliding, but let's say the customer satisfaction, right? So we were not where we needed to be. We set this goal. We want to hit that goal, that minimum goal, really consistently. But once you hit that goal, that minimum goal consistently, like you're good, you know how to do that. That is a really good time as a board to say, you know what, maybe that goal is not good enough anymore. Maybe our goal is going to be higher, or maybe our goal is going to be to build that over time to such and such another number, in which case you'd have a slanted mark in that trend analysis. That's a great question. Yeah.
That is all the questions I have. I would be happy to, if someone has something they want, it looks like somebody's putting a new message in. Margaret, I had a question myself. It seems as though getting regular financials in some co-ops, it's just very difficult, that they really struggle with that. Can you talk about ways that could be made easier, or is opportunities for co-ops who are struggling with this to find some help in getting these out? Are there resources available to educate them
and help them get financial statements? Or
yeah, I mean, I don't know if there's resources in terms of going to other cooperatives, like Rural Electric, that might help a co-op, or yeah.
So I'd say for lots of people, and particularly in our sector, somebody gets into being a caregiver because they're a caregiver. I mean, because that's what they want to do, right? Not because they want to look at financial statements. They'll say, I didn't enter this field, so I could do that. So for a lot of people, it's not something that's intuitive, and it's not something that they know what to do with. But you know what? We're all business owners, and this is kind of the language. It is one of the ways that we are able to talk to each other about this thing we share, which is our co-op, right? And so it's really important to have your financial statements be accurate and be timely, be regular, because it's like if you, I don't know what, told somebody months later about something that they needed to know yesterday, it's like, well, that's communication, but it's not like really helpful. So I think one of the things to do is just to say it's a commitment, and then think about what's getting, like specifically, what is getting in the way of having these financial statements regularly. Somebody does it, maybe they don't have time, maybe they don't have the expertise, and maybe having somebody, like you suggested, from another more a co-op that is in a good position could come help whoever does the bookkeeping, just clean it up and get us on a regular basis. So one good thing about financials and bookkeeping, I mean, there's certainly things that are special about our industry and numbers that are important to our industry that are less important to somebody else, or important to them. But the standards are all the same. I mean, the things you input, are the same. So somebody could come in with QuickBooks and just help, like, let's enter a bunch of stuff and make sure we enter it in the right place and all that kind of stuff. I would say that that's really important. It's a hard sometimes it's hard when you get behind to make time for it. But it really, it's going to be hard to do anything if you don't have the right information at the right time, because just think of another thing in your life where you found out about a sale on something, and then you got the sale flyer 3 months after the sale ended. You're like, well, that was great, but I can't do anything with that. And that's same with a lot of financial stuff. If you find out way too late that, you didn't get a check from somebody that you were supposed to get a check from, and it's 3 months late already, and you didn't even know it, and now you don't have any money in the bank, all that stuff, it kind of creates more crisis. So I just say it like really committing to it and saying honestly, like without shame, what is getting in the way? And if somebody doesn't have the skills they need, we just get it, or we can, find them. There's all these bookkeeping co-ops that are bopping up all over the country, like get some help. Like somebody can help us do it.
Thank you, Margaret. We've got a couple other questions.
Yeah.
In this industry, would the goal line differ seasonally? In other words, can you expect more business in different months?
That's a good question. And in some ways I would say no, right? People need care all through the year, but somebody's particular market, it might, and so that would be a thing for your co-op to look at your past years and say, for whatever reason in our market, I don't know, maybe somebody's in like a vacation area, and so they get a bunch of business in the summer because there are all these people that just live in that town only in the summer and not the rest of the year. So that might be a co-op that would have seasonality to their business. And for sure, if you have seasonality in your business, you would want to plan for that. So that's one of the reasons, and two of the tools. One of them is a comparison to last year. If you look historically and you'd say, okay, we can see that summer's always a big year for us, because of our town or our community. That's where comparing to last year this time is really important, because comparing, July to November isn't going to help you a lot. You want to compare July to July and say, are we doing as well as we did last year or as we expect to do? The other place where if you do have a seasonal business, and home care isn't usually that seasonal, but for businesses that are seasonal, the cash flow becomes super, super, super important, because you are going to, have a lot more money in some parts of the year than in other parts. And so you're probably going to have to plan for that. Maybe you need a line of credit from your lender, so that you make sure that you have enough money for things when, you do a bunch of work, but then you don't get paid for a couple months. And then, so you have the expenses, you have to pay people that payroll when payroll is high, but maybe that's, that particular customer doesn't pay for a month or two. And so you're not going to have the money to pay people. So yeah, cash flow becomes super important in seasonal businesses. And you just
Here's
have to be
another one.
planning. Yeah, go ahead.
On the balance sheet examples, what's the difference between net income and retained earnings?
Okay, that's a good question. So net income is this year. This year or this month. Here's our net income right now where we're sitting right now. Retained earnings on a balance sheet is net income that the co-op saved for the co-op, that the co-op kept internally from previous years, from other years. So a high retained earnings number would say this co-op has historically been profitable. And co-ops can decide, boards, you can pay some out in patronage, and you can retain some for the co-op every year. And so that becomes retained earnings for the co-op.
So to clarify, both the net income and retained earnings, that's unallocated equity.
Yes.
It's only the patronage that is going to be paid back to the members.
Yeah, so that's a little bit in the weeds. But if you say we had a good year, our net income was high this year, so the board's going to say, okay, we're going to share some with patronage for members, and then we're going to keep a little percentage for the co-op because the co-op is growing and we know we need some working capital, so we're going to do that. So you might pay that patronage in cash, so then it goes off your balance sheet because it goes to the member. You might pay that patronage but retain some of it, and so then it's in equity, but it would be called like retained patronage. So retained earnings would really be unallocated. It would be money that was earned that the board decided, what, the co-op needs some money of its own for growth reasons or other reasons or cash flow reasons or whatever. And so we're going to keep some money in the co-op because the co-op needs that money to survive and exist. So we're not going to, allocate all the money to patronage. We're going to keep some.
Thanks.
Right. And then is there an average percentage of caregiver co-ops for gross profits?
Of the co-ops, that is a question. We do a benchmarking
Yeah.
And I haven't looked at the
Stay
recent
tuned.
number. Right, stay tuned. There is a number, and somebody should be talking about it, right, Leslie, at a different session?
Yeah. Let me,
Can we poll people right now?
We could. You mean what their average profit is?
Yeah.
You know, it's something, ICA tracks that, and I don't have those numbers. That's a really good, but we should actually have them, Leslie, and give them out. If we're not doing it in a different session, we should. We should do that as some
I'm just
kind of
looking here, see if we got any others. Oh, I guess that's it.
okay.
So it's 2:29. I apologize for the translating glitch. I don't know what that is yet. We have a debrief afterwards, and we will make sure it doesn't happen again. Any questions that weren't answered or come up later, put them in the chat and we'll run them by Margaret and she'll answer them. And be sure to fill out the evaluation form at the end of.
Maybe I went to another one.
And everyone, the link to that survey is in the chat now, so you can just click on it right from the chat box.
Okay.
Yeah, but I believe I went to another meeting. To another
Thank you.
breakout. Well, they finished already, so.
Thank you so much. And we will see you tomorrow morning at noon Eastern time for the start of the conference. So goodbye.